Hello. Welcome to Option Bank, your premier options trading platform. In this video, we would like to guide you through the basic concepts of the stock market. Imagine you are a young and new company and are in need of money to invest in a new project which costs, let's say, more than $1 million. Banks won't lend money to young companies, and your friends and family may not have that much. What should you do now? One idea is to divide your company into little pieces and sell those little pieces to investors. Each little piece is called a share of stock. Buyers buying those little pieces become shareholders in your company, and share the risks and rewards of the performance of the company. Issuing stock is advantageous for your company because it does not require you to pay back the money like a loan, or make interest payments along the way. Your investors make money when your company is profitable through the dividends the company pays out, or by selling the stocks they purchased from you at a higher price to other investors. This profit on the appreciation of the stock price is called a capital gain. However, investors can lose money if your company cannot make profit or goes bankrupt. The price of the stock goes down and the investor sells the stocks at a loss, or they cease to have any value. So where are stocks traded? Stocks are traded through exchanges. Some exchanges are physical locations where transactions are carried out on a trading floor. An example of such an exchange is the New York Stock Exchange, founded in 1792. Today, most stock market trades through an electronic network, which means they are executed electronically, and even the stocks themselves are almost always held in electronic form, not as physical certificates. An example of such an exchange is the Nasdaq, founded in 1971. The stock market provides companies with access to capital in exchange for giving investors a slice of ownership in the company. The first time a company opens itself to public investors and sells stock to them is called the initial public offering, IPO, which is referred to as the primary market. Institutional investors typically purchase most of these shares from investment banks. All subsequent trading goes on in the secondary market, between investors themselves. Participants in the stock market range from small individual retail investors to institutional investors such as mutual funds, banks, insurance companies, pension funds and hedge funds. Their buying or selling orders may be executed on their behalf by a floor trader. Now, let's find out what are stock indexes. Indexes are used to measure changes in the stock market. There are many different indexes and each represents a pool of stocks. For example, the Dow Jones Industrial Average is comprised of the 30 largest stocks in the US, and the daily Dow reading shows how these stocks perform on a given day on average. The Dow average is a price-weighted average, meaning it is based on the price of the stocks. Similarly, the S&P 500 is comprised of the 500 stocks with the largest capitalization that are traded in the US. These two indexes are generally accepted representatives of the overall economy in the US and are the most followed measurements of the US stock market. There are many other indexes that represent mid-sized and small-sized US companies, such as the Russell 2000, S&P Mid-Cap 400 and S&P Small-Cap 600. International indices are all based on the same logic, and they are broad averages for stocks traded on that particular market. For example, the FTSE 100 is for British stocks, the CAC 40 for French stocks, the Nikkei 225 is for Japanese stocks, and similarly many more. Thank you for watching.